It's 2 p.m. in Geneva, 1 p.m. in London, 8 a.m. in the East Coast of the US. This, for these people of my generation, this reminds me of the opening of Live Aid, when like somebody says it's 2 p.m. in Philadelphia and whatever. So this is the first joint Graduate Institute CEPR seminar on COVID economics. And this the idea of this seminar is to present some of the papers which have been published in the new journal produced by CEPR, vetted in COVID economics, vetted in real-time papers. We are trying to catch up with medical sciences, try to provide fast refereeing for preprints. And so this is our first seminar, and we're very happy to have today one of the first papers published in this journal, which is been written by Laura Alfaro from HBS, Anusha Chari from UNC Chapel Hill, Andrew Greenland from Elon University, and Peter Schott from Yale School of Management. Anusha, Andy, and Peter are with us, and Anusha and Andy will present the paper, which is titled Aggregate and Firm Level Stock Returns During Pandemics in Real Time. So everybody is in real time. So as I said, this is the first seminar of our series. We're going to have a seminar each week on Tuesday at this time, and we already have a great lineup. Next week, we'll have Harald Ulig from Chicago. Week after, Chris Pisaridis from LSE, and the week after, Anton Korinek from UVA, and then we'll have more. So Andy and Anusha will speak for about 40 minutes, and then we'll have about 20 minutes of question and answers. Use the Q&A thingy of Zoom. If you have quick clarification questions, one of the authors who is not speaking might be able to provide an immediate answer. More substantive questions, we'll take them from the end. So I guess we're ready to go. Anusha, are you starting?
So thank you so much, Ugo, for having us on this series. And it's a pleasure to present the inaugural paper. And what I'm going to do is to set up our experiment, and then Andy will walk us through the rest of the details. So as Ugo already said, the title of our paper is Aggregate and Firm Level Stock Returns During Pandemics, and importantly, in real time. Slide, Andy. What really got us started on this paper is to look at the evolution of the market and how the stock market was responding to information about the disease progression. And during the COVID-19 pandemic, the tension between Wall Street and Main Street has become quite palpable. And what we all know is that in the early weeks of the outbreak, US markets dropped by almost 35%. And perplexingly, even as reported infections continued to rise and jobless claims started to climb, the stock market rallied. So the goal in our paper is to investigate precisely how investors might incorporate the expected impact of the disease progression into aggregate and firm level stock returns in real time. And a follow-up goal is to really try and provide a rationale for these seemingly divergent narratives about the state of equity markets and the state of labor markets. And the name of the game is really going to be to try and extract unanticipated changes in predicted infections And we are going to do this in real time, which is to provide daily re-estimates of parameters based on very simple epidemiological models of disease forecast, and then use these unanticipated changes in predicted infections as our measure of news to see whether this has an impact on the stock returns on the following day. And we do this not just for the COVID-19 pandemic, we also do this for the SARS pandemic. So just to give a little bit of context, when we look at standard asset pricing models, these models generally compensate investors for taking on risk that cannot be arbitraged away. So we're really talking about systematic risk. And one sort of feature is that the evidence suggests that these models perform quite poorly during times of great volatility. And times of great volatility, like crises, so if you think about 9/11 or the global financial crisis, as well as at the beginning of recessions. So these standard models perform really poorly during these times of heightened uncertainty. And one reason that's been put forward as to why this might be the case is that during times of high volatility, investors' ability to accurately forecast cash flows and discount rates, which is what market valuations are comprised of, the investor ability to forecast accurately is compromised. And following the global financial crisis, the models sort of switched to attempting to incorporate the risk associated with disasters or real events. And the methodology is primarily to focus on firm level distributions of stock returns, focus on the tails, and try and extract some aggregate common dynamics in these firm level stock returns. But key features of these disasters and rare event models, key features of the shocks are that A, they are of large magnitude, B, they are systemic, so affect all firms in the economy, C, they are of low probability, and D, it is hard to price risk under these circumstances precisely because the nature of the risk itself is unknowable. So when we sort of turn to the COVID-19 shock, we see that it checks all of these boxes. It is of large magnitude, it is of low probability, even though virologists might disagree and expect more pandemics in future years. And finally, given the record volatility that is associated with this unknown shock, it is sort of not surprising that standard asset pricing approaches struggle and have low predictive power for stock returns. And in fact, this is sort of consistent with newspaper articles during the outbreak that express sort of are puzzled about the market's gyrations or the market movements. And we argue that it is this investor ability to accurately forecast cash flows and discount rates, which is compromised during this time, and instead take an alternative approach, which is to think about, well, where could we find a setting where there would be a shock that would be so salient that we could extract a signal that swamps out the noise and allows us to price assets. And the most sort of natural candidate during a pandemic is the trajectory of the disease progression, and that is what we do in this paper. We zero in on the information or the health shock process to extract the signal in a situation where the signal to noise ratio might be high in this setting. And so this is essentially what we're going to do. I'm just going to walk you very quickly through the methodology. We, as I mentioned earlier, are going to focus on simple epidemiological models and try and extract news from the trajectory of disease progression and see whether it carries information for market returns. And the advantage of this approach relative to existing approaches that focus on stock return predictability or classic event study scenarios where you try and extract abnormal returns is that what we are doing in our paper is to exploit the exogenous changes in information about the trajectory of the pandemic. And so the steps are relatively simple, which is the first thing is to model cumulative infections based on either an exponential or a logistic curve, and then re-estimate the parameters each day, because each day what we are getting is new information on reported cases, and therefore the information set that we have is reported cases up until the market starts trading. So new information about cases is released after the markets close. And once we have this information set, which has the history of recorded cases up until a particular day, we can re-estimate the parameters to forecast the trajectory of the disease for the future. And once the market closes, new information about recorded cases comes out for that particular day. And this difference in information sets, which is the difference between what the model predicted given the history of the information till the previous day versus new case information that comes out after the market closes, gives us these unanticipated changes in the disease trajectory. And this is the new information that the market receives before it starts going into trading the following day. And so what we are trying to do is to extract this news and then see whether market returns at any given day T, whether they be aggregate returns or firm level returns, co-vary with this news of the disease progression. And let me go over briefly our findings in terms of aggregate returns. What we see is that larger unexpected changes in new cases, which is if we have increases relative to what the model had predicted, or unanticipated increases relative to what the model had predicted, these are correlated with greater declines in market returns. And in particular, if we see a doubling of predicted COVID-19 infections, the US coefficient estimates suggest declines of 4 to 11%. And this is based on the Wilshire 5000 index. And when we did this type of analysis for the SARS pandemic, we see a similar pattern where we see declines of 8 to 11% on the Hong Kong Hang Seng index. And in both cases, the advantage of our approach is that we can look at both increases as well as decreases in predicted infections. And what we see is that declines in predicted infections are correlated with increases in market returns. And this sort of leads us to believe that investors might be using this sort of information to update their beliefs about the economic consequences of the outbreak as the disease progresses. So our measure of unanticipated cases or unanticipated changes in predicted infections might in fact comprise a summary statistic that that summarizes information about the economic consequences of the outbreak for investors. And this sort of helps resolve the puzzle in our view a little bit, that equity markets may recover and become less responsive to new cases as the trajectory itself becomes more certain or starts to flatten. So this might be one potential explanation for the recovery that we see in April of equity markets as the disease curve starts to flatten and hopefully decline. Now we can use the same technology of looking at exposure of returns to the COVID-19 shock to identify the channels of exposure by drilling down to the firm and industry level as well. And unsurprisingly, on average, changes in market value across the board, across industries in response to the COVID-19 forecast, these revisions are negative. But what we also see is that they vary a great deal both within and across sectors. So we compute these betas, which is the exposure to the COVID-19 shock at both the industry level and the firm level. And what we find is that it's consistent with our priors. Industries where social distancing is hard and have been the most exposed to the shock exhibit the greatest declines in market value. And these are things like accommodations, which is hotels, entertainment, movie theaters, transportation, which is airlines, etc. So it's completely consistent with our priors. And by way of contrast, what we see is that firms in industries where it is easier to work remotely and have been to some extent less affected and are therefore less sensitive to the COVID-19 shock, which is sort of mostly services like education, professional services, and finance are less sensitive and therefore experience lower declines. At the firm level, what we find is that in industries that are capital intensive, where capital costs are sunk, that are more leveraged or more debt laden, and given that debt is a non-state contingent instrument, as well as firms in less profitable sectors experience larger declines. And this basically means that sort of signals to us that perhaps these industries are not able to shed production costs or other costs associated with their operations quite so easily. Whereas if we focus on labor-intensive sectors, which report, interestingly, the largest jobless claims, those sectors actually have lower declines. So it sort of is sort of a clue to resolving this puzzle of equity markets rebounding while jobless claims surge and giving seemingly contradictory signals about the underlying state of the economy. So I'm going to stop over here and let Andy walk us through the rest of the details and the project. So take it away, Andy.
So what I'm going to do now is I'm going to talk us through more or less the details of the findings that Anusha outlined. And the way I'm going to start is by giving us an overview in a little bit more detail about what we think the investor's timeline looks like and how the case forecasting actually takes place and how we're going to estimate the case trajectory to COVID-19 and of course to SARS as well. Once I've talked you through this case forecasting exercise, I'll show you an application to COVID-19 where we're going to discuss our findings on aggregate and firm level stock reactions. And then we're going to try and validate our interpretation about this cost shedding mechanism by linking the industry level declines in market value to a measure of spatial exposure to this economic component of the COVID shock across US labor markets, where we're going to demonstrate that there are increases in jobless claims in locations that had lower declines in market value. And so we think this is, again, consistent with the idea that the equity markets may be rewarding firms precisely because they are able to shed costs. So we're going to start off here with the investor's timeline and a basic introduction to our case forecasting exercise. And so I just want to highlight again how we're going to be thinking about investors forming expectations based on the timing of data release, as well as Anusha's previous outline. So we're going to be thinking about this as the market trying to forecast the sequence of future cases that we're likely to experience from COVID. And the key assumption that we've got here is that the observable cases on any day T become known after the market closes. Now, this is consistent with, at least in the US, that the World Health Organization is putting these cumulative case counts out after the US markets close, and then they become publicly available on these larger dashboards. One of the most commonly used is the Johns Hopkins COVID-19 tracker dashboard, and those don't become accessible, these new updates, until 11 o'clock at night, 1 o'clock in the morning, 2 o'clock in the morning. And so that information about the cumulative case counts could be incorporated into equity market prices only on the next trading day. And so what we're going to do here is specifically consider the market's beliefs about some day T0. We could use today as an example. And we're going to think about two specific forecasts here. So this forecast in blue, this C superscript T-2, is what the market would have expected during trading yesterday about the number of cases we would see today. And then as this new data is released, and the market can incorporate this into its updated expectations about the trajectory of the pandemic, that's going to be new information available to the market before the market starts trading today. And so what we're going to focus on here is the log change in these forecasts, which is really just the difference in the trajectory of the pandemic, as indicated by the change in the number of cases we would have expected to see today, given the new release in information that we just got this morning. And so we're going to be tracking this element over time. And as an example of how this works, what I'm going to do is talk about exactly how we're going to be forecasting this, and then give a simulated data exercise that shows how our method will actually work here. So in order to forecast a sequence of cases, we actually need to take a stand on how we're going to be modeling this. And there are two sort of approaches that have taken hold here. One, as many of you have, I'm sure, seen, is in this class of SEER models, which is a very structural approach to thinking about the mechanisms we might use, or epidemiologists might use, and policy makers might use to impact the trajectory of the pandemic itself. But these SEER models are not really designed to be forecasted on a day-to-day basis. They're more designed to think about how different interventions might impact the trajectory of these actual pandemic itself. And importantly, the understanding how the mechanisms work and understanding how to actually fit these models may require data and parameters that are not known at the time of trading, particularly early in the pandemic. And so what we're going to focus on are a more simplified version of these models, just so-called growth models. And these can be estimated with very little data. So only a few data points allow us an opportunity to forecast the potential trajectory of the pandemic. Of course, we're not going to be able to run any of the counterfactual exercises that we would think about with any of these SEER models, though. And so we're going to focus today on two possible approaches to this. One is the logistic growth model, and the other is an exponential growth model. And we'll talk about those briefly right now. So what I'm going to show you here is a series of different logistic growth curves. And what I'm going to be plotting on this vertical axis on the left is the cumulative number of cases we observe at any time t. And on the right-hand axis, we'll see the new cases that show up at any time t. And the solid lines are going to show the cumulative case count, again on the left axis, whereas the dashed lines are going to show the new cases at any point t. And the three different shades of gray here indicate different potential growth rates or expansion rates of our pseudo outbreak, if you will. And so what we can see here is that these simple logistic models are going to capture the same kind of patterns we would think you would observe in some of the more sophisticated SEER models, which are that you can see growth in terms of the number of cases, the so-called flattening of the curve, and then this ultimate flattening out of the total number of cases we're going to observe by the end of the epidemic, which is something that if we were to model this with a more simplistic exponential growth model, obviously exponential growth is going to continue indefinitely. But what we'll see here is even if the model is actually this sort of logistic or SEER format to begin with, on short-term projections, day to day, the exponential growth function very nicely approximates this logistic growth curve. And so what I'm going to show you here is if we were to take this dark black line here, okay, so a relatively slow growth rate, 2.5% in our cases, what it would look like if we were to try and actually estimate the trajectory of this pandemic in real time using in red this actual logistic function, which is the data generating process, or the exponential function in 1 day ahead forecasts. And what we'll see is particularly early on, the exponential forecasting model works very well to capture the growth trajectory of this logistic, this underlying logistic data. Now, what we're going to do today is we're going to be focusing on an application that uses the exponential growth model precisely because it has the properties for estimation are a bit easier, and there are points in estimating the logistic model that we may not achieve convergence in estimating the logistic model, particularly early on in the pandemic, when investors are going to be incorporating the most information about the trajectory of the pandemic, because the growth actually looks quite exponential very early on. There's not a lot of indication of slowdowns in that growth, which you would need in order to estimate this sort of flattening out that you observe in a logistic model. So again, what we're going to be thinking about here is I'm going to show you now what these two different forecasts would look like in our trading time for this simulated outbreak, okay? So again, in blue here, I'm going to show you what the forecast for today's caseload would look like based on the information we had yesterday during trading. And in red, I'm going to show you the forecast for today's case growth based on the information that was just released this morning. And so again, what we'll see here is that these both track upward over time. And on days when the blue line is above the red line, these are days when today's forecasts are better about the progression of the pandemic, in the sense that we expect there to be less cases given the information we saw. And so the green line, which is this change in case forecast, will end up being negative. And that's going to be on your right axis here. Conversely, when we see the red line above the blue line, these are days when the new information we just saw about case growth tells us that the pandemic's trajectory is likely worse than we thought. That is, the case growth is higher than we would have anticipated given before we got this new release of information. And so again, this green line being positive here is going to track with unexpected news that the pandemic is worse than we thought. And so what we're going to do is take these daily revisions in case forecasts here and map these to the daily returns on various stock markets at both the aggregate and the industry level. So I'm going to show you what this same case growth curve looks like here when we apply it to COVID-19. So again, what we're going to show here in the blue, and this is just for the US data, just to be clear, and we're going to start here on January 22nd, which is the first day we actually observed cases in the US. The gray line here is going to actually track the number of cases we see in the US, and we have a logarithmic scale on the left-hand side. So this is cases in thousands, and the blue and the red again are going to be these 1-day leading and 2-day leading forecasts, and the green line is again our measure of new information. So what we observe here is that early on in the pandemic, there's a lot of initial high growth, which means that every day we don't see that same kind of extreme growth, the case forecasts end up being lower day to day, which is potentially good news for the market. But as we see these abrupt increases in the slope of case growth, these are points where we're going to see substantial revisions in the future forecasts of the COVID-19 cases that are going to play out primarily through the most of March. But then as the curve becomes more predictable, as there's enough data that new additional information doesn't really change forecasts very much, the new growth prediction curve here flattens out almost entirely towards the end of March and the beginning of April. Now, I've just talked you through intuitively what's happening here, but what I'd like to do is briefly show you what this would look like in real time if we were thinking about this as an investor. And so what I'm going to show you here in the top graph is in red, this is the actual evolution of the case series for the US. And the pink cone that's out ahead of this red curve are these forecasted values that we would expect to see in terms of case growth over time. The black dashed line is going to track this unexpected change in case growth that we just outlined on the previous slide. Then what I'm going to do is match this unexpected change in case trajectory here and just play it out in real time against the US stock market close as looked at through the lens of the Wilshire 5000. And what we're going to see is a very similar pattern here, that while we're getting initial information about the trajectory of the cases, the stock market doesn't move much. But as soon as we get these first spikes, either upward or downward revisions in case growth, the Wilshire 5000 seems to move in the opposite direction, suggesting that investors may in fact be pricing this information in real time about the trajectory of the pandemic itself. What we're going to do next is slightly more formally evaluate this. Let me take this back to full screen here. We're going to more formally evaluate this in a simple regression where we look at the log return or the log change in an aggregate equity market index here, the Wilshire 5000, against this unanticipated case growth. And what we see is a scatter plot that reveals the same kind of pattern we just observed in this that time series GIF. That is, as unanticipated cases increase, equity markets decline, and as they decrease, as unanticipated case growth decreases, equity markets see higher returns during those periods as well. And so we think this helps shed some light on why the equity markets may be recovering here relative to their performance in late March, is that over this time, the trajectory of the case growth has stabilized and in some senses reduced relative to prior expectations. What we're going to do now is turn to thinking about how we can quantify firm level exposure to this. And we're going to do it in the same fashion, except that on the left-hand side here, what we're going to be estimating are the daily moves in firm returns against this same unanticipated case growth. And with that, we're going to be able to estimate a firm level measure of exposure to this news about COVID's trajectory. And what I'm going to show you on the left-hand side here, we'll focus on this black line. The black kernel density plot here shows the distribution of these firm level betas. And what we can see here is that they are overwhelmingly negative, as we would expect given the scope of the COVID pandemic. And we observe that actually 96% of firms react negatively to news of these new case growths, with a paltry 3.5% to 4% actually seeing positive reactions to expanding cases. On the right-hand side, what I'm going to show you is the distribution of these measures of firm level exposure based on the firm's primary sector for production. And what we're going to see here is what Anusha previously pointed out, that mining, entertainment, construction, things that require a lot of face-to-face activity and are going to be challenging to incorporate during social distancing, exhibit the most sensitivity to these new releases about COVID information, whereas on the other extreme, agriculture, education, things that we think of as both being relatively low in capital as compared to mining or construction, and are consistent with social distancing, see less sensitive returns to these estimated firm level measures of beta. And so what I'm going to do now is explore a little bit more formally what some of the drivers of this exposure are, and we're going to do that by looking at a firm level cross-sectional regression that will regress these betas, our estimates of firm level exposure, against observable firm characteristics that we might think would give some additional insight. So again, our dependent variable in this regression is our firm level measure of exposure. And what we're going to do here is take a sort of production function approach to this question and ask, does firm size, as proxied by the assets net of property, plant, and equipment, impact the firm's exposure to COVID? That is, do bigger firms or smaller firms respond differentially to this? And the first, generally across the board here, we see a very insignificant relationship between firm size and exposure to these COVID shocks. The things that do tend to be significant predictors, however, are property, plant, and equipment, employment, and profitability. What we observe here is that as capital intensity or property, plant, and equipment increases, firms' returns become more sensitive to these COVID surprises. And on average, what we observe are that more capital intensive and more debt-laden firms exhibit more negative returns in response to these COVID information shocks. Alternatively, more labor-intensive firms and more profitable firms see relatively less negative returns in response to these COVID news surprises. Now, these findings are consistent with some of the work by Ramelli and Wagner, who also show the important role that debt may play in constraining firms' response to the COVID outbreak here. But our interpretation of this isn't entirely just that it's a debt-based response, but the fact that employment is positively associated with returns while capital is negatively associated with returns leads us to believe that this may be a reflection of the firm's ability to reduce its costs during a recession, the scope of the one we're currently in. That as global revenues contract, firms are going to exhibit higher relative returns based on their ability to scale back their production. And capital-intensive firms, by the nature of capital being almost entirely sunk in a global downturn of this magnitude, are going to have a hard time scaling back production, whereas labor-intensive firms are going to be much more easily able to shed production costs by either furloughing or firing workers as a way of reducing their output to accommodate reduced revenues and reduced demand. We see, again, a similar effect here when we look at debt holdings. In the same way, as Anusha said earlier, debt is non-dischargeable in this setting. And as a consequence, firms that have these costs that they can't shed during this downturn are going to be ones that are going to be more sensitive to the coming economic contraction. So what we're going to try and do is validate our interpretation of this production function approach to identifying channels of firm exposure. And we're going to take a slightly atypical approach to it, but one that we think is going to lend some insights into the divergent narratives about the state of the US economy as told through the equity markets and labor markets. And we're going to do that by linking these equity market reactions to labor market outcomes across the US that are taking place right now. So what I want to do here first is give you an overview of what the US labor market has looked like over the last couple of weeks. Now, on the vertical axis here, what I'm going to do is plot the number of new jobless claims per worker. That is, we'll take the total labor force in a state in 2016, the last year for which we have data on this. And each week, I'm going to plot the number of new jobless claims we see per worker. So this is in percentage points. And what we see here is that as of 3/11, which is the date that the World Health Organization announced that COVID-19 is a global pandemic, we see the jobless claim per worker jump from about 0.2% per week up to roughly 6% per week. So these are not cumulative figures here. This is the new jobless claims per worker across states in the US. Over this 6-week period in the US, we've seen roughly 30 million workers file for unemployment and lose their jobs during this period. And so what we're going to try and do is see if we can both rationalize our interpretation of the equity market reactions with these labor market outcomes. And so we're going to do this in a very straightforward way. Since we have already estimated firm level exposure to COVID via these initial firm level return regressions, what we're going to do is use the cross-section of these firm-level measures of exposure and relate them to the cross-section of holding period returns over January 21st through April 15th, the same period during which we're going to be analyzing these labor market reactions. And what we're going to see here is, as we would expect, as firms' exposure increases, remember that the vast majority of these beta J's, the measures of firm exposure, are negative. 96% of them are negative. Their returns decline over this period. And so what we're going to do with these changes in predicted returns, we're going to be able to come up with a change in the market value of the firm attributable to US COVID cases, which we will then aggregate to the industry level. And then we will map to the spatial distribution of, or we will map spatially to labor markets using this industry level change in market value derived from our firm level estimate here. And the way we're going to do this specifically is we're just going to take an employment weighted average of these industry level losses, where the weights are the employment shares in a region in that industry. And what this is going to give us is a measure at the county or state level of the decline in the market value that the workers face that's attributable to COVID. And so what I'm going to do is show you what a map of this spatial exposure looks like in the US. So in our darker purple here, what we're going to see are locations where workers are employed in sectors that did not exhibit substantial declines in market value, okay? By contrast, in the darker browns and oranges here, what we're going to see are workers who are employed in sectors that exhibited substantial declines in market value. And so in the center of the US here, where we see the most orange, and then across part of Appalachia here, these are locations that are primarily tied up in mining activities, natural resource extraction, and the like, all of which happen to be very capital intensive activities. By way of comparison, a lot of the East Coast and major metropolitan areas, including some of the West Coast as well, these are locations that have experienced lower market cap losses. And so what we're going to do now is link this measure of spatial exposure to the change in employment conditions in those states. So what I'm going to show you here is a very simple scatter plot of this change in the state level market value against the change in, or against this cumulative jobless growth. And what we'll see generally is that as states experience lower declines in market value, they exhibit larger increases in jobless growth. So I'm just going to pick on Hawaii here quickly. And what we're going to be thinking about is the fact that Hawaii is primarily a service-based, labor-intensive state comprised of both air travel as well as hospitality, tourism, and the like. And so if we're thinking about economic contractions that are going to cause global declines in revenue, what we would expect is that if Hawaii is intensive in sectors that are primarily labor driven and have a lot of social interaction, these are places that are going to first furlough or cut their workers quickly. And they are going to be places that, because of firms' ability to cut and furlough workers, investors are going to penalize them less in the market as COVID cases come out. By way of contrast, on the far left-hand side here, we have Wyoming, which is almost exclusively in natural resources and very capital intensive in production. Capital costs can't be shed during a large downturn. And as a byproduct, the market value declines a lot, but laborers are not shed off. Again, it's very capital intensive during this. I'm going to evaluate this more formally here in a simple difference in difference specification, in which we regress the jobless claims per worker, which will be our dependent variable here, against this market cap loss, this change in the market value at the state level. And I'm going to interact this with a dummy variable for the post period, this large vertical spike here after we observe the status change to a global pandemic. We're going to identify off of the switch in this timing and the state's difference in its, the spatial difference in the state's exposure to this as measured by these changes in industry market value. This coefficient at the top is going to indicate that an increase in market value loss, that is a state that sees a larger contraction in the market value of its economy, is going to see lower jobless growth. Okay, again, this is consistent with the idea that the market is going to penalize firms that cannot shed costs. As an implication, industries that can shed costs are going to exhibit lower market losses, but states intensive in those types of industries are going to exhibit higher jobless growth. Now, this result obtains accounting for weak and state fixed effects, as well as recently developed measures on the extent to which work is teleworkable, whether there are active stay-at-home orders in place at each week in each state, and controls for the quality of our workforce match from the NAICS level to the state level, as well as the underlying labor market size. Again, our interpretation of these findings is that the market is penalizing firms that are unable to shed costs, leading to a contraction in the value of firms that are capital intensive, and states that are intensive in that type of industry are actually seeing less jobless growth over this period. So our takeaway and our conclusions, again, overall, what did we do here? We documented that daily financial market reactions respond to unanticipated changes in case growth, both to COVID-19 and SARS, which are estimated in the paper. We identify a 4 to 8% decline in the market index for a doubling of unanticipated case growth, but importantly, we also identify increases in market value as case growth flattens. We then estimate firm level exposure to these unanticipated news surprises about the trajectory of the pandemic, and it seems to be linked to the firm's ability to cut costs during this period. And of course, combined, these have implications for the spatial incidence of jobless growth across labor markets. All right, that's all I've got.
Okay, thanks a lot, Anusha and Andy. This was excellent, and I love this technology of the webinar that you know, the co-authors can answer the clarification questions as they come along. So we have a little bit more than 10 minutes. So if anybody has questions, please send them in. Maybe while we are waiting, if other questions are coming in, I would like to pick up again the question that was sent by Kalina Manova that Peter quickly answered. And I think it fits well with what Andrew was talking at the end. This is basically a question: what do you learn? What do we learn from your estimation from, you know, the long run effects of the crisis? So I don't know if you guys want to elaborate a little bit more on that.
Yeah, sure. I don't mind weighing in on that. So, you know, I think from a baseline, what we're trying to do here is promote a way of thinking about how these market reactions are actually giving us information about which firms are likely to be exposed. And in terms of the long run implications, we think the ability to match this to labor markets may provide some insights about which locations across the US and potentially other countries that are able to use a similar measure are likely to see more either long-term unemployment effects or related effects. So this links back to the rather large literature on the spatial incidence of trade shocks, which you're quite familiar with, where we could be thinking about, are there some locations in the US in particular which have very poor fiscal status and are more likely to have losses in public and other social goods? There's a variety of labor market outcomes we think this could be linked to. And another important aspect we think is useful of this is data on spatially disaggregated labor market outcomes is going to be slow forthcoming. We only actually have state level information about the spatial incidence of unemployment loss, and disaggregated, like American Community Survey, county level measures and information may not be available for at least another year. And so we think of this as providing some early insights about the spatial incidence of these labor market shocks before the more direct data may be available.
So
Okay.
I'd like to add to that by saying that I think Kalina's question is really getting at what's driving the market valuations, which at the end of the day depends on the present discounted value of expected future cash flows. And what we see is that the reason that these models perform poorly during times of heightened volatility is that the market has a hard time forecasting these expected future cash flows and discount rates. And so Kalina has a very valid point in that the long-term effects are really going to be dependent on how these supply chain linkages and demand shocks ultimately get priced into the market. But what our evidence is showing is that during this time of a lot of noise and a lot of volatility, the market's response seems to be loading on the disease progression. It remains to be seen how this correlates with exposure to supply chain shocks and demand shocks. And those are going to take time to actually, for us to get information on all of that.
And as Anusha just said, I just want to say one more quick thing here. Her point that it's very tough to forecast changes in discount rates and revenues is precisely why we think that investors' reactions may be attributed at the firm level to the cost side of this. Because if I can't forecast what's happening to revenues, I can at least very easily see if these firms are very capital intensive or labor intensive and are likely to be able to reduce costs in the face of a global downturn.
So Charles Whiplos has raised his hand, would like to ask a live question. So can we connect Charles? Yeah, here he is.
Yeah. Yes, thanks for an excellent presentation of a very important paper. I have a question about the missing part of the story, which is during the crisis, nearly every day well, I exaggerate a bit, you have announcements by the Fed or by the government, and the Fed has been working very, very hard to prevent a meltdown on the asset markets. And it can have a differential effect on different firms depending on location or kind of business they do. Am I right to understand that this is missing from your estimations?
So we actually, we included a government policy tracker index to try and see how the market was responding to information about government policy, both on the monetary policy side in terms of what the Fed was doing, as well as on the fiscal policy side. And what's interesting is that I don't know if it's the noise that's swamping it out, but we didn't find any statistical significance related to that government policy tracker index.
Now, one possible way of tackling this is you might imagine that we dealt with that in a very typical event study way, which would be to just include a dummy variable for the information, the timing which the information about these Fed announcements are released to the market, for example. But it may be the case that because the Fed has introduced this, it's really sort of a regime switch. And so what we should be thinking about here is how the new news about these cases is interpreted in this period after the Fed implements this new policy. And that's a really good point, and that's something we're working on incorporating into the current draft.
There was an interesting question from my friend Riccardo Puglisi, which Peter hinted at answer, but maybe this is worth. So what Riccardo was saying, in a cross-country exercise, you would expect that this interaction with cost shedding has different effects depending on laws that protect employment. And in fact, this is probably also in the US, because there are different labor market flexibilities across US states, right? And I saw that Peter said it's something you plan to do in the future, but if you want to say something about that.
So,
Peter, you want to take that?
Yeah, please.
Unmute yourself.
Yes. Yeah, so we've thought quite a bit about this mechanism, and it's mostly been an issue of trying to get data as fast as we've thought of the ways of taking a look into it. But yeah, I guess in general, the spirit of your question is quite good. if there are things that interact with firms' abilities to shed costs, and more, in general, if those are policy-related things, we would like to control for them and explore them. I think that doing so would help flesh out the mechanism even more.
And to be honest, it's a very interesting question. I mean, it provides interesting variation in thinking about how these policies might ameliorate some of these losses for laborers as well. Being able to exploit this across countries would be a really interesting exercise.
One has to learn how to mute and unmute himself. There were a couple of technical questions about controlling for other risk factors in the asset pricing equation. I don't know if this was already answered. It was answered. Okay, you can go ahead anyway.
Yeah, so the general stance we've got on thinking about how to control for these risk factors from a traditional asset pricing standpoint is it's actually turns out to be a little bit complicated even within the context of traditional asset pricing models. Because in the traditional sort of CAPM kind of approach, you would expect that normal covariance with the market, the firm's normal returns covariance with the market, captures its exposure to systematic risk. But the financial crisis sort of revealed that these baseline measures have a hard time accounting for this extreme tail risk, which is precisely what COVID is. And so if you were to estimate any of these multi-factor models and use these factor loadings as additional controls, you would in theory want to estimate them during the COVID period so that you had information on how exposed these firms were to this, but that of course confounds the analysis. So we're very sympathetic to that point. We do in fact control for a contemporaneous measure of the firm's exposure to the market as well. And our results are qualitatively similar. The rank order of these firms roughly stays the same, and so the industry exposure stays the same as well.
And we're able to do this sort of Fama-Macbeth type analysis with the COVID factor and with the market return. And, we can basically use that as a measure of the exposure to the COVID factor. One of the issues with the other sort of Fama-French factors is that they're also being updated in real time as we speak. So that information is not yet updated and available.
Good. When I started reading the paper, I had a question in mind. I had an idea in mind about exploiting, geographical variation. But then when I saw where you were going to with the paper, I thought it maybe was not such a good idea. But since we have a couple of minutes, I'm gonna throw it to you. So at some point I thought maybe you have, in the Wilshire 5,000, you have, 5,000 firms. And some of them might be more exposed to certain regional areas. So I don't know if that's the case, but let's assume the IHOP has more restaurants in the south or than in the north. I have no clue if that's the case. But so could you, and so it does less of a demand shock because, there is less of a lockdown in the south and in the other thing. Could you in a sense, classify firms to regions, certain firms, clearly not all of them, and sort of extend your model by looking at cases at state level?
It would be perfect if Laura was here because she is currently working on putting together data on the locations of firms' facilities across the US so that we can get a cleaner measure precisely of this spatial incidence. We hadn't thought of inverting it to look at the locale cases and see how that manifests in stock returns. We were going to go the other direction and see if that gave us a cleaner measure of our labor market shock, but I think that's a really great idea. We can definitely embed that in that going forward.
Okay, so I don't see any more questions. So let me just thank a lot Andy, Anusha, and Peter for being here. So this was our first seminar of this series. I think we got with a great start. And so again, we'll have this joint seminar. And I'm happy that Charles is here because Charles is the editor of the COVID journal. So we'll have each week at this time we'll have a talk. So as I said, next week we'll have Harald Uhlig from University of Chicago, and will be hosted by Beatrice Vedder. Will be even a bigger time span. Beatrice is in Singapore. Harald, I assume, is in Chicago, so it was like 13 hours difference between the two. And then the week after, we'll have Chris Pissarides hosted by Charles, and then Anton Korinek hosted by Cedric T, and many more. So thanks a lot again to Peter, Andy, and Anusha, and I hope to see everybody again next week at the same time.
Thank you very much.
Thanks very much, Ugo. Thanks for the opportunity.
Yeah, thanks for having us. Thanks for coming, everybody.
Thank you.